These are the investments I made in the month of August. In the month of August, after expenses, I had around $1,000 left, plus $300 more from the dividend income that I've received from this portfolio, giving me $1,300 to invest. I'll be breaking down each investment I made, my thesis for making the investment, and what I think my future plans are for that particular investment. And before we get started, please smash the like button, smash the subscribe button. We have to do it for the algorithm. Prayer hands. My biggest investment, like always, was in the S&P 500 or the 500 biggest companies in the United States of America. The American economy is the #1 in the world, doesn't seem to be going anywhere anytime soon, and investing in the 500 biggest companies in the best economy in the world does seem like a good idea, at least for me. And I invested in the S&P 500 through this ETF called VFV, a Vanguard product particularly for Canadians because I live in the Maple Land, where you can find several other ETFs by BlackRock, Vanguard, any major index fund provider that you like. And why I think investing in 500 companies and ETFs in particular is a good deal is because the risk is minimized. By investing in not just 1 or 2 or 3 stocks, but 500 different stocks, even if one of these companies goes under, for some reason, let's say Microsoft goes under or Apple goes under, nobody knows the future. But it's not very likely that all 500 of these companies are going to go bankrupt or not turn a profit in the future. So that's why I like investing in this ETF. I also invested in the NASDAQ 100 or the 100 biggest companies in the United States of America. This is extremely tech focused and you're going to see a large drawdown or a tremendous rise because it is extremely volatile. If you don't like tech, if you think for some reason the tech industry is not going to be profitable in the future or it's not going to create value, this might not be for you. But for me, being around tech my entire life, I think there's a lot of value to be created. If you look at your personal life, everything that you use has some tech in it, especially with the bigger companies like Google with search, Apple with the iPhone and the MacBook, and Microsoft products that a lot of businesses use to get their day-to-day work done. Big tech is not going anywhere anytime soon and might even become bigger in the future. So for me, the NASDAQ 100 is a good investment, particularly through this ETF called HXQ. As for US companies, my biggest buy was Google. Internet giant, search giant, YouTube giant, ads behemoth. Google is extremely profitable and in fact recently declared a dividend, which shows me the company's confidence in maintaining its cash flow for the foreseeable future. Not only the dividend, the stock price has done extremely well in the last few years, although it is down from its all-time highs of nearly 200 in recent months. The balance sheet is extremely promising, with Google increasing profit quarter on quarter and with an extremely interesting play in the AI race now with its Gemini product. It might even add more value. People are debating whether or not Gemini is a good product and whether integrating it heavily onto their new smartphones, the Google Pixel, is a good decision because the functionality of Gemini is not there yet as compared to other AI products like ChatGPT, for example. But you have to remember though, Google has the most amount of data, the most amount of users, and ads are not going anywhere anytime soon. As long as there's people to sell, there's going to be advertisers willing to sell to them, and Google with its leadership might make the best use of its data and turn this profitable company into even more profit. Also, the PE ratio or the price to earnings ratio is extremely good right now. It's priced extremely low, which suggests to me that the market or most people don't expect it to increase its revenue by a lot, but I think that is a mistake from my personal viewpoint. Of course, as with individual companies, this is a risk and I understand that, but I think it's good enough to invest one share in. My next investment was in a cybersecurity player, Fortinet. Fortinet is a cybersecurity company that provides services like VPNs and firewalls, amongst other services used by businesses day to day. It has been on a mammoth rise in the last few years, but I think it has extremely strong leadership and top-notch products. With cyber attacks and cybersecurity tripling and even quadrupling according to some researchers in the near future, Fortinet's products, particularly FortiGate and other flagship products, are going to do extremely well in the future. They've already seen a massive increase in customer base, and with interest rates going down in the future, spend on software products always goes up, and companies like Fortinet tend to be extremely price sensitive to interest rates, since spending is oftentimes fueled by debt, and if it's easier to get debt, it's easier to spend on software products. So it's more of a short-term play, but also a long-term play. Investing in a major cybersecurity player. A new aspect of my portfolio have been enhanced growth ETFs. We all know what growth ETFs are. Investing in the S&P 500 or the NASDAQ 100, ETFs that are predicted to provide you tons of upside in terms of the stock price growth and not so much in terms of the dividend income that they give you. An enhanced ETF essentially adds leverage to that. In simpler terms, let's assume that an ETF, like an S&P 500 ETF, increases by price 10% per year, which it has done for the past few decades now. If a A leverage ETF adds 25% leverage to that. That means that it is going to increase by 12.5% roughly, minus leverage costs. So let's just assume 12%. Although there is a downside to that. Let's say we enter a period of recession and the S&P 500 drops 10%. A leverage ETF is then going to drop 12.5% or thereabouts. So you see the promise and the risk here. The promise is that your returns are amplified, and the risk is that if you enter a period of long drawdown, your losses are also going to be amplified. Plus, the cost of leverage is always a debate. But for me, I made the decision to invest in an enhanced ETF tracking the S&P 500 in USSL and also a total market enhanced ETF in HQL, because I'd like to think I'm young right now, which I do think I am, hopefully. And I think I can withstand short-term drawdowns and look at the long-term potential for these ETFs. And once again, this is no crazy leverage like 2 or 3x leverage. This is only 25% leverage. A new part of my portfolio, very interested to see where this takes me 5 or 10 years down the line, but something to keep me interested, and if the returns are actually good, I might add to this position. My last investment in the US stock market was in a covered call ETF through HYLD. Now this covered call ETF tracks pretty much the S&P 500, or more specifically, some industries in the US market like finances, healthcare, tech, etc. And covered call ETFs, like I've mentioned before, are extremely controversial. They sacrifice long-term potential growth for income now. So you'll notice that my covered call investments have not returned much compared to my S&P 500 investments. The returns are significantly lower, even more than 10% lower. But the income is more than 10% higher, with some of these ETFs like HYLD having a yield of close to 12%. Now, why do I choose to do this? Why do I choose to invest a slight percentage of my portfolio in covered calls? Is purely for motivation and seeing income now. When I started investing, I didn't see much income, maybe $50 or $60 every month. It wasn't much to talk about. But now that income is starting to grow and starting to snowball, and I am seeing multitudes of hundreds of dollars pour into my portfolio for basically doing nothing. I do recognize covered call ETFs sacrifice a lot of potential in terms of growth, but this income keeps me more motivated to invest and save, which I think is a very big factor for me. If I'm not motivated, I'm not going to save enough, and my portfolio is just not going to build fast enough. However, if I sacrifice some potential long-term growth for a large percentage of increase in saving now, that is worth more to me than that extra 1, 2, or 3%. So once again, a small part of my portfolio goes into this just to keep me motivated and seeing that income come in, those juicy dividends. Moving on to my Canadian investments. My first investment was in the TSX 60, or the Canadian version of the S&P 500, through this ETF called VDY. This is a Vanguard product and basically tracks pretty much all of the big Canadian companies listed on this exchange. And a good thing about this ETF is that the dividend yield is much higher, although the growth is slightly lower. The Canadian markets have recovered a bit in this year since the Bank of Canada has decided to cut rates before the Federal Reserve, extremely weakening the Canadian dollar, but stocks are doing well, so I guess there's a win-win-win-lose lose-lose situation. My primary objective with this ETF is once again taking part in that modest growth, but also those dividends, and betting on the Canadian economy, since I do plan on living in Canada in the future as well. But I think Canada's abundance in natural resources and its position as an immigrant welcoming economy and its proximity to the US particularly is going to benefit it quite a lot in the future. Just my bet on the Canadian economy, which is why I decided to buy this ETF. I also bought a covered call ETF tracking the Canadian economy as well by buying this ETF called HDIV. This ETF essentially tracks the TSX 60 plus a bit of exposure to the US, and the yield is exponentially higher than the TSX 60. And the good part is actually the growth performance is also not bad because it tracks the US market. So I'm sort of getting the best of both worlds here, and this has performed well so far for me. Once again, not a lot invested since covered call ETFs sacrifice a lot of potential growth, and being young, I do want to partake in this growth, just enough to keep me interested and just enough to keep that income rolling. Last but not least, my favorite part of this video is the crypto baby, going to the moon, going to beyond that, going to Venus, Pluto, which is not a planet apparently and now is a planet or not. Crypto is extremely volatile. That is why I only chose to invest a small percentage of each of these savings into it. And I only buy Ethereum. I believe Ethereum has the strongest ecosystem of any cryptocurrency in terms of the amount of companies building products on the Ethereum blockchain. Crypto, whether you like it or not, has extremely real use cases in dinosaur industries. For example, finance. When I send money abroad, it takes me days to send money, and I understand there's financial regulations, but a lot of it comes down to the bureaucracy and the inefficient processes placed in financial institutions. Crypto aims to solve that by using the blockchain. Not just finance, there's also applications for other industries, but I do think that in some world where crypto actually does get a mainstream acceptance, Ethereum is going to be at the forefront just because it has that ecosystem and that initial first movers advantage. So $50 in crypto, not much, and as you can see, my crypto holdings, i.e. my Ethereum holdings, have been down and are down close to 20%, but I don't care since I'm not touching this. Very small percentage of my portfolio, and I want to see how this does in the future. So those were my investments for this month. Let me know what you bought. Let me know what you sold. Let me know if you disagree with my investments or you agree. Please agree, because that would make me really happy. And as always, don't forget to smash the like button and the subscribe button if you want more of this content. I hope you enjoyed this, and I'll see you in the next one.